All right, let's talk the West Greeley Project and all the studies we've been hearing about. So you've probably heard people say that the studies show that this project works. But here's the thing, there isn't just one study. There are 5 separate studies, and they all look at different questions. The CBRE looked at how the arena might operate day to day. The HLA is actually a 2-for-1. It looked at whether the project can pay its debt, split between a report looking at market demand and financial feasibility, and one looked at economic impact. Then we have the EPS, which looked at estimates of economic spillover. So basically money that we get as a result of spending elsewhere. Then there was Zonda, the final one that was paid for by the city, which looked at housing demand. And finally, we have the Newmark analysis, which is the independent firm that reviewed all of it together. None of these studies on their own say this project is financially safe. The only way to understand the real risk is to look at all 5 together and not just quote the most optimistic parts. So the CBRE, what it does and doesn't do. So it was the market study that looked at how the arena, ice rink, and hotel might operate day to day. It estimates revenue and expenses. The CBR states that it estimates potential operating performance under stated assumptions, and that the results are hypothetical and not guaranteed. It worked on quite a few assumptions. So one of those is that there's a second anchor tenant, aka a second professional sports team using the arena, even though no such team is secured or even in talks with us. It's also boasted that the Eagles have 96% occupancy at their arena currently, but their capacity is only 5,300 at Blue Arena. And most AHL teams actually have 7,000 to 12,000 capacity. And when I looked within the CBRE, it said that the Eagles are actually in the bottom half of attendance. They're ranked 19 out of 31 of teams that have higher attendance numbers. Average attendance needed by the CBRE is 8,250 per game, which is a 56% increase from current, and would have our attendance have to be the 6th most attended team in the entire league. Also, it looked at occupancy rates requiring 63% in the first year. Denver occupancy rates, with all of their downtown, all of their activities, are around 70%. By the end of year 3, we'd have to be at that 70 and only increase from there up to 82%. The CBRE also assumed that we would have 579,000 people annually attend events at the arena. In case you want to do the math, that comes out to over 11,000 every single week. And they looked at having to have 120 events a year, 20 of those coming from the second sports team that we don't have. Also, as I looked at the hotel, they are assuming a starting rate of around $250. That's before our public improvement funds and taxes, which, according to information I found from the city, raises the cost of anything in the district by about 25%. But even before then, we're looking at $250, which is more than the Gaylord in Colorado Springs and Cheyenne Mountain Resort in Colorado Springs. It also looked at assumptions for the water park at a rate of about $75 for weekend day passes to the water park. In case you were wondering, Water World is $31 to $48. So we'd be looking at almost doubling what a ticket would cost to go to Water World. And they're looking at needing 200,000 annual day passes each year. That comes out to about 3,800 people having to visit every single week. Another assumption is that long-term capital must be met with only 5% reserves. This is way below current industry guidance, which I think looks at like 8 to 9%. Attendance and utilization assumptions exceed local performance that we've seen in anything else we have. So CBRE isn't saying that the project can pay for itself. It's saying if everything goes right operationally, here's what income might look like before we pay the bills. The conclusion they came to is there is reasonable market support and need for additional ice sheets in the area. Cool. However, ice rinks are relatively high profit margins compared to the ice arena, so the arena itself doesn't have that big of margins. And the water park, while profitable, exhibits high expense margins. A new arena of the proposed size can be supported by the regional market. The ice rinks are the strongest and most stable component, and a hotel and water park can perform as a destination-oriented asset if demand is induced as projected, so on their lofty projections. This is dependent on high utilization, strong event programming, induced hotel demand, stable operating costs, and continued regional growth. What the CBR doesn't account for is it doesn't include debt payments. Their numbers stop before interest or bond payments are due. And even then, they still show that the net operating income, which is calculated before interest expense and debt service, is highly sensitive to even small shifts. So that's the CBRE. Then we had the H&LA, Hotel and Leisure Activities. I forget what the A stands for, that's okay. The fundamental question of this study is, can the project pay its debt? They looked at feasibility and debt service. They directly compared income to debt obligations. They tested multiple scenarios, and then they evaluated long-term financial sustainability. They also had their own operating assumptions, which are actually more aggressive than those on the CBRE. And we know that the CBRE already had pretty lofty projections given our area, given what we have around the area and what would have to happen. So the HLA report assumed that the arena was going to have 505,000 total arena visitors every year. And they upped from that 120 events a year to 240 events a year, and also included a line item that implied that there would need to be 182 smaller events within the demand. For reference, Blue Arena had 88 events in 2024. We're looking at doubling that on the Blue Arena had 88 events in 2024. We're looking at needing 240 a year on this, or 120 as we look at the CBRE. So they looked at a couple different scenarios. In the first one, their assumptions looked at the first year hotel occupancy rate having to be 68.6 compared to that closer to 60% of the CBRE. They did go down a little bit on the average rate, but that's because they're assuming more rooms in the hotel, adding about 11 rooms at least from what the CBRE had said. Then at the water park, they're looking at 70,612 total annual water park visits. Again, doing the math, that's 1,358 visitors a week, which comes out to almost 200 a day. Again, reminder, Water World tickets, $31 to $48. We're looking at an average ticket price according to HLA of $60. And Water World has 70 acres and over 50 attractions. The conclusion that HLA came to is clear. Based on operations alone, the project doesn't cover its debt payments. Not for 9 years in the best case scenario, and not for 16 years in the other scenario. The 9 years is when we looked at the possibility of the Mattel branding. But I also want to say, by the way, there isn't a signed contract despite what's being shared by Greeley Forward. And this was based on original project costs, which have already increased by over $30 million just since last fall. They even say in plain language that the project is not financially feasible on its own. That's not my opinion. That's the consultant's conclusion. So why are we saying that it still works? If the project can't pay its debt on its own, why are we being told that it works? Well, here's the answer they're using. They're counting on outside tax revenue to fill in the gap. Sales tax, lodging taxes, property taxes, not just from the arena, but from the surrounding district, Cascadia. In other words, the plan depends on future development, future spending, and future tax capture to subsidize the project for many years. So the next study was the EPS study, and this looked at spillover spending. So this study estimates spillover spending, which means people who visit the arena or hotel and then spend money at nearby restaurants and stores in our city limits. This study estimates about $19 million a year in surrounding spending, but this is based on assumptions about visitor numbers and how they spend. Economic impacts are estimates, and they don't represent guaranteed fiscal revenue, according to the EPS. And even the study says that those numbers for spillover spending don't automatically pay debt. It only helps if the city can actually capture and dedicate those tax dollars. And we also know that Cascadia Catalyst is going to be close to Centera, to Johnstown, to Windsor. And so this is counting on $19 million being captured still within city limits and not going to our neighboring communities. So what has to go right for this project to work? Let's see. So far, we need a second sports team that we don't have. Strong event booking. Blue Arena is direct competition just up the road on I-25. They've only been doing 88 events a year. We're looking at needing between 120 and 240. Full build out of the district. So we're counting on all of the housing, all of the mixed use, everything coming out the way they said, when they said. Strong residential demand. Stable interest rates, which we don't really know what's happening with the economy, and stable economic conditions, and reliable tax collections. So then the last one that the city did of the feasibility studies looked at residential demand and market risk. This was the Zonda residential study. So it analyzes housing demand and absorption, looks at affordability, interest rate pressures, and one thing, spoiler alert, they emphasize there's a lot of market volatility. And housing projections affect tax revenue, because if the houses we build don't end up getting filled, then those people aren't living there and therefore aren't spending their money. Or if the housing costs are too expensive, there isn't discretionary funds to then spend at Catalyst or at the restaurants in the area or other retail. Zonda cautioned, projections are subject to change as market conditions evolve. This had some of the strongest caution language. It said that conditions are volatile, affordability is strained, and projections need constant monitoring. In plain English, housing demand is not guaranteed. And if the housing or commercial pieces stall, the tax revenue that's supposed to help pay for the arena stalls too. I also want to be clear, this isn't about being anti-development. This isn't anti-arena or anti-growth. It's about honesty. The studies don't say this project is safe. They say it's conditional. And when a project depends on everything going right for decades, residents deserve to know up front before irreversible commitments are made. So the final study was an independent review by Newmark. After all these studies came out, a simple question came up. Did anyone independent actually review them? The answer is yes. A nationally recognized firm, Newmark Valuation Advisory, which is recognized as a leading trusted advisor for large institutional investors and owners, was hired by Greeley Demands Better to review the city's feasibility and economic impact studies. Their job wasn't to advocate for or against the project. It was to ask, are the assumptions reasonable? Are the numbers supported? And does this actually work financially? What they found matters. The studies are missing some key aspects. Something that Newmark flagged was that should concern everyone is that the study assumes a smaller project cost, about $665 million, and shows manageable debt payments. But the city's own financing model shows over $800 million in bonds, with debt payments rising to $70 million a year. When Newmark lines up those with realistic income, the project stays deeply negative for years. Newmark's conclusion is direct. They found that part of the city's studies are unsupported, overly optimistic, or misleading without full context. Most importantly, they concluded that the combined arena, hotel, and water park do not generate enough income to cover debt service under realistic assumptions. In other words, even if things go well, the project still struggles to pay what it owes, unless outside money fills the gap. Newmark looked closely at the arena projections. They found that the more optimistic forecasts, especially those used in the financing models, rely on aggressive assumptions that don't line up with comparable arenas. Newmark actually says that the CBRE projections are the most realistic, and those are millions of dollars lower than the numbers used elsewhere. When you base financing on the higher numbers, even small misses create huge long-term problems. Economic impact isn't the same as money in the bank. We keep hearing about the economic impact of this project. Newmark explains that why that can be misleading. These studies often count gross spending and not net benefit, meaning they don't subtract spending that wouldn't have happened somewhere else or money that leaves the city entirely. Newmark points out that the retail spending is likely to leak to Loveland, Johnstown, and Fort Collins, and not stay in Greeley. Economic impact sounds impressive, but it doesn't pay the bonds. They also looked at public support for projects like this. It's not unusual, but Newmark points out something important. Most similar projects receive 10 to 50% public support, not 100% public financing. Newmark could not find comparable arena or water park projects that were fully financed and carried a long-term risk entirely by a city. That level of exposure isn't standard. So let's put all 5 studies together and get the full picture. When you look at everything together, the CBRE, Hotel and Leisure Advisors, and the Newmark with EPS and Zonda, a consistent picture emerges. Operations don't cover debt. Financing assumptions are optimistic. Economic impacts are overstated, and long-term risk shifts to the public. Supporting development is one thing, but making billion-dollar decisions without clever, realistic financial footing, to me, that deserves a pause. Also, let's not forget the projected revenues are before the Eagles take their cut of concessions, events, suites, parking, naming, all the things that we gave them in the original agreement. So this is based on us receiving all of that money, but we still have to pay them their part. Something that we're still missing is that these also only look at the original project. We haven't looked at the increase in cost, and we haven't looked at what happens down the road. Martin Lynch said himself back in 2024, buildings like Blue Arena have a shelf life of 25 years. Buildings wear out and new technology and innovations emerge that aren't easy to retrofit. Also, water park attractions require refurbishment and or replacement every 10 years on average, according to my research. Arenas have an average lifespan, he was pretty close, of about 30 years unless they undergo significant repair and upgrades. And hotels have a lifespan of 30 to 35 years on average. Where is the money to do these repairs and upgrades when we're looking at not even being able to make payments on principal, only paying on interest, until 2038, according to the city's projections? And that's assuming that all of these projections pan out and we meet the projections as they are. So what do we do when we're 40 years down the line and we don't have a building anymore, or we don't have the money to keep it active? Also, Highway 34 and County Road 17 interchange that the most recent ad has been saying is going to be covered by the developer. Despite what these ads are saying, according to City Council's last work session on January 27th, they were told there's no contract signed that the developer is covering the cost of the interchange. And in fact, there's $102 million in funding that's required for this interchange that has yet to be secured or identified. Newmark didn't say never build anything. What they said is be honest about the risks, the costs, and who carries them. Transparency isn't opposition. It's how communities protect themselves. As I take all of the studies together, what it tells me is we need to slow this down. That's why I'm voting yes on 1A, so we can slow down, go back to the drawing board, and make sure that we're actually taking care of our community and not